Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I will be your host here for about the next, maybe 25 minutes on Options Guide TV. All right. I think everybody knows what day it is. Fed meeting day. Fed's going to announce right around 2 o'clock if they're going to be lowering interest rates or increasing interest rates. Wink, wink. Yeah, right. They're looking at about 100% chance that they're going to lower interest rates at this point in time based off the Fed funds futures watch. But there is a question. There's still a small probability that they could go 50 basis points as opposed to 25 basis points. So any hints that there might be, I don't know, going into the end of the year, another rate cut is expected, and everybody be listening to see if there's any hints that that rate cut might be 50 basis points. And that's what I think everybody's going to be looking for. They're going to be hanging on that news. And today, after the Fed meeting, that is very potential. There's a very high probability of something odd happen. No, I wouldn't say high. Something out of the ordinary happening in the Fed meeting, more so than normal. Let's just put it that way. More so than usual. So I want to get to it because I want to do a one-day butterfly. Vols have jacked on the one-day implied volatility. The butterfly is cheap. Now you can make it an open wing. You can do our standard scenario, but we want to get it on because we should have had it on at 10:30ish, and the show doesn't start till 11, and then it took a couple of minutes. So let's get it out there. All right, let's share the screen. Here it is. SPX just hanging right around 6,600, which also makes it fun. We can go 20 points wide and spend $3 on this butterfly. So if you go 56.80, sell the 5,600, buy this, 65.80, 6,600, 6,620. There's a lot of sixes in there. All right, that doesn't make it simple on me at least. Okay, look at this, $3. That's cheap. That's cheap. That means that we got the VIX not even really that elevated relative to be able to get this cheap. So the one-day implied volatility has to be really high on these options. We're looking at a VIX trading at 1639. So the VIX is elevated a little bit. Like I said, I think that it's the anticipation that something out of the ordinary may happen this time around. Now, if you believe that, don't put this trade on, right? If you do think that there's a probability that they go 50 basis points or that they lean towards 7 rate cuts going into the end of the year or something odd is going to happen, well, if that is the case, well, then you shouldn't do this trade. Now, you can lean into it if you want. Our standard is to go directional, right? So directional in this instance, and I didn't look at it, but would mean that you would either cut this down to 5 points on the short spread or 10 points. So let's take this and we'll start at 10 points and see if we can make it profitable above 6,610. Yeah, we can. That's not that shabby either. Okay, so you're paying $730 for this, and just to let you know, I already have a butterfly on. I put it on earlier. And if you pay $330 for this, or $730 for this, you can get out at 10. So that would be 3. Yeah, that's not bad at all, right? So if you want to go directional, you got to pay up a little bit more. I usually try to find something that's for between $300 or $500 for Options Guide TV, just so that it's a very simple thing to paper trade or, experiment with. But we're going to send this to the what if calculator, and you'll see that above 6,610, this trade will be profitable. Click the send a ticket. 1 second. Okay, pull this down. There you go. And zoom in. Apologize. This is getting a little screwy. It will happen with the derived value on 0 DTE options. So ignore that, because this is where the market would go at expiration, right? So anywhere above this, if you pay attention to, your eyes would be over here to show you the profit and loss. But it's saying that if the market goes above 6,610, that this would be $7. You would be up $290. So they're saying $3. So they're saying that you put this on for $7.10, because the maximum it would trade for would be $10. So the what if calculator grabbed $710 when we came into the calculator, and this is what we're saying. Now on the downside, we'd be down that amount. So 700, yeah, there it is. That's the maximum that it grabbed. $710. Right now it's saying it's $730. It's going to move. It's going to move quick. It's going to move fast. Boom, boom, boom. Before you know it, this thing's going to be either trading for 8 or trading for 6. That simple. So if you want to lean bullish, you can lean bullish. You could even go, let's try 5 points more, because it was $3. See if we can get this done for $4.90. No, not quite. Okay, that doesn't work. That means that we'd be flat above 6,615. And you can flip the script. You can go bearish on it if you want to. If you want to do that. Markets are obviously toppy, so leaning bearish is not, this is a precipice as far as the market is concerned. I think we've been building to this point. I don't mind looking at a volatility trade. Let's see what we got let's quickly look at the VIX quotes, and that's a derived value. So ignore that value, by the way. And what we're more worried about, the actual VIX is a little bit higher than that. It's 1638, and right now it's at 1609 on the derived value. Explain that later, but it's basically using the formula that I use when we look at the monthly options. So October 22nd is the monthly, this because it's in the green, VIX, and we got to look to see where the call and the put change. I would guess it would be somewhere around 18 or 19. No, it's down. That's 18. Okay. $2, 197, and then this is it. So it's between 18 and 18.25. So boom, one, and sell this one. Oops, I didn't mean to do that. It means to be a sell on the put side, and that will tell us where we're at. 13 cents. So we're at 18.13 on the October 22nd VIX futures contract. Okay, so the VIX, if you don't know what I'm talking about, go to my X handle at Brian Overby and read my article written that is called Decoding the VIX. The VIX is an odd bird in that you can't buy implied volatility explicitly, right? If you're thinking of futures and you're doing futures on corn, you can go buy a bushel of corn, but you can't buy implied volatility. You can buy options that have implied volatility, but you can't buy actual volatility. So to me, it's like doing options on the weather. And that's kind of what you can't go out and buy the weather forecast, right? You can't buy the future weather forecast. You can look at the almanac, you can make that for but you can't buy the weather. Just like you can't buy the VIX, you can't buy the volatility. So because of that, the futures trade just obscure. There's no set formula where you take the cost of the goods, you forward those costs, you see what that interest rate would be, and you come up with, well, in the future, based off of this current price, the forward price would be this. It's not that simple. So right now the VIX is trading right around 1820, and I like that trade. Let's see where the VVIX is at. That's got to be well over 100, I would think. VVIX. 102, 102.94, 102.94 on the VVIX. That's normal. That's not abnormal. That's right about what where you normally are at. The low end on the VVIX, this is the volatility of the options, the 30-day volatility of the options in the VIX. The low is around 90. And the peaks on the upside are around 110. Yeah. If you're thinking about VIX trades, market's at 18. You're paying a couple of bucks for them. Now, that is a lot of implied volatility, right? It's saying that it's like 133%. And that's true. You're paying, you look at the cost and it's inexpensive, but you realize it's an $18 underlying at this point in time. So that's what leads to it being inexpensive. But I don't mind even buying the at the money one here. Now, I like to leg into spreads now because the difference is so huge. I mean, I would be looking for the VIX to get big before October 22nd. Yeah, so we could do one of two things. Okay, we can buy it or we can do a spread. If the problem with doing the spread is if you do a spread and you get way out here and you sell all this volatility and the market does tank, the implied volatility, like the VVIX can go as high as the highest over the last year was 170, right? That's how much volatility can jump from 100 to 170 on a big up move. And what will happen is these things will inflate so fast. So in a way, I like to buy calls and then leg in and sell the other call against it. But then again, that obviously you're taking risk in the platform. And I normally wouldn't talk about that with retail clients, right? What we're doing right now. $2, gosh, you can do the 28 and still get $7 on it. That's 10 points higher. All right. So if you want to do a spread, which is a little less, I don't know. Okay, let's look at it. I'm going to put this out here. This will be a paper trade. I'm long VIX options already. I've been long them ever since the VIX in October dropped below 20. So I'm not going to do this trade, but I think this is an interesting trade, and I would want to do it before. If nothing happens after the meeting, volatility will come off a little bit on this. But I don't mind doing the spread before the meeting. You could wait till after. And if nothing happens, it's even a little bit more enticing. If you actually see this future come down and trade at 17 or 17 and a half, that let's say if it went down 1 point, it would be trading for what the 19 is right now. It would be trading for about 167, right? Because if it went down 1, the 18 would be 1 point out of the money. What's 1 point out of the money right now? The 19s are. So here, we'll make this a paper trade if you're interested in doing it. I don't see, and if you got questions, because I'm just kind of winging it here. If you got questions, please do put them in the chat box. Happy to address them. And Kurt, as always, wishes everybody a good morning. So we'll pop that one up. Good morning, Kurt. All right, let's hope it's a good morning. Let's hope. Right now, the market's trying to decide if it's going to be good, just hanging around, waiting for the Fed to speak. VIX creeping up, market going nowhere, basically. Good news that the Russell's up a little bit. That's usually a good sign. But lower interest rates does help the Russell. Okay, so here we go. That's the small caps. Let's get rid of this. And here would be the paper trade. If you want to do it before the big event, because who knows, the big event could be a big event. That's where I would go. Right there. $1.19 for, and I'll make that official paper trade. That means we'll follow it. Send that to the what if calculator. We'll go 10 points wide for $1. Right? Basically the cost to go out to dinner nowadays. Almost the cost to go to McDonald's, to be blunt. If you got a family of 4, that's about where your bill's at. $119 for a 10-point wide spread, putting our maximum upside at $881, but we needed to go above 28 and finish above 28. If you're doing this and the market went to 28 tomorrow, this is where the issue comes in. You just wouldn't be as profitable. This line is actually looking fairly accurate, the green one. And this is what I was kind of muttering through, should I sell the 28 call or not, right? If I do, and the market tomorrow goes to 28 in the VIX future, with that October expiration, this is all the profitability we would have, is approximately where this green line is at. It's a very straight line because there's so much volatility. And the issue is that this option contract wants the market to go down. And if it doesn't go down, you got to buy it back to get the profits on this option. So on the way down, you see the VVIX go up, you see the VIX or the call options go up. I got counter to what the market is doing. And you don't get to take advantage of the pumped up implied volatility by selling this out of the money spread against this. So like I said, I kind of like to just buy it and be ready to sell. I don't mind legging into it. So the market jumps to 25, let's say. Well, then go out and sell some premium, because now you got the pumped up implied volatility and you're getting the premium. You're getting what you should get if you want to leg into the spread, right? So that's where we're at. Yeah, I have long VIX. We mentioned it on the show for quite some time. I think the VIX was around 19 when I put it on. I am down on the position right now, but it's one of those that you just buy and you're looking for that event. Maybe today's the event. We'll see. But we're heading into the end of September, beginning of October. Haven't really had any volatility. This will be if it holds, I mean, it'll be the first time in. And it works until it doesn't. And that's always a great phrase of trading. But I mean, I'd have to ask Russell Rhodes, the good friend of mine, the VIX, the expert in the VIX, how many years it's been where September and October weren't more volatile than the rest of the months on the calendar. And I would guess 15 to 20 years, somewhere in that range. So this is where I'm at. I'm willing to speculate with a couple of bucks. Now realize that this isn't meant to be a recommendation, because first of all, this is a real speculative trade. So you're not going to go out and take 50% of your portfolio and put it into this trade. This is a 5%, 10% of the portfolio type, or I should say 5%, 2 to 5% of your portfolio, like a small part of your discretionary money that you could put into this trade. Very, very small end, not 5 to 10, 2 to 5, somewhere in that range. Okay. All right. Any questions? No. All right. UNH down a little bit. Unexpected. Didn't really see that one coming. It's back up today. Our butterfly that we put on, probably still doing it all right, but you may have already gotten out of it. The UNH is, we want it to be at 340, and we got 2 days remain, 345. Okay, so 340. Let's see where it's at. 2 days remaining. Buy. And you may have already gotten out. I would think that, because there were many opportunities to get out of this trade. Sell 2 of the 345s. And then I got to pull it up, make it bigger. 335, 345, 350. Buy. Sell 2. Buy. Yeah, we're still even okay. And that was a fairly big down move that we had yesterday. So you're still all right on the trade. The trade was $3.65. We're showing it for $3.98. You want it to go to 345 or beyond. This actually isn't a bad range that it's hanging out in right here. So it's been a real good trade. There's been many opportunities to get out of the trade, and I think I'm going to stop looking at it. I think that will be the end of the UNH trade, and I do think that this is the end of the time. So last chance. Let's go back and review. I didn't put the – oh, good, I did. Okay, so here are the two trades. You can either do the skip strike or you can do the regular butterfly. I did the regular butterfly, thinking that things were going to be more contained than lean towards the upside or the downside. Saying that vol was going to come off because it's so high. So I'm expecting to get out of this trade probably by 210, 215 right after the announcement. And that's the way that I plan on trading it. If you want to lean bullish or bearish, it's inexpensive to do it. It's not that bad to do that trade, but I was able to get into it for $2. So that was a no-brainer to me to just see if volatility can come off and I could sell it for $4. Hopefully at 2 o'clock today or 2:15. Now, on the long vertical spread on the VIX, this is, like I said, a very speculative trade. If you don't want to pay $2 for it, here's a way to pay $1, right? But I gave a lot of background as to why I don't really want to sell the 28 strike, but it really... I'd rather sell it. I'd rather be long the call and sell the option after you get a move. And if you don't get a move, or you can just sell the option, right? You don't have, that gives you a little bit more opportunity, a little bit more flexibility. But if you want to just do a one-off trade and think the VIX is going to spike sometime between now and October 22nd, there you go. That's the trade. Thanks for coming, everyone. And I don't see anything in the chat box. That's it for this episode of Options Guide TV. Come back on Friday. Let's see what happens. Make sure you set your alarm 11 a.m. Eastern time inside the Tradier Hub, hub.tradier.com. Hope to see you in the hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.